Japan's 10-year government bond yield touched 2.4 to 96% on April 13th. That was the highest level since 1997, 28 years. A temporary Iran-Israel ceasefire brought yields down briefly in early April. But that ceasefire did not solve Japan's structural inflation problem. Japan's producer prices just jumped 6.1% in May, confirmed and verified. That number proves the underlying price pressure never actually disappeared. You're watching Capital Word. Subscribe right now. This matters directly. Drop a comment. Are you tracking the BOJ's June 16th decision closely? Stay until the end. The split vote data changes everything completely. The Bank of Japan kept its policy rate steady at 0.75% on April 28th, while revising inflation estimates upwards as the Iran war raises supply-side risks. The decision came in a split 6-3 vote. Federal Reserve 6-3, not unanimous. 3 board members already wanted higher rates. The dissenting members proposed to raise the policy rate to 1%, arguing that tensions in the Middle East had skewed price risks to the upside. Federal Reserve to 1%. That is the exact level markets now expect on June 16th. 3 members were right 6 weeks early, before producer prices confirmed it. The BOJ cut its growth forecasts for fiscal year 2026 to 0.5% from 1%, and raised core inflation forecasts to 2.8% from 1.9%. Federal Reserve. Growth cut in half. Inflation forecast raised by nearly a full point. Both moves in the same meeting, both signaling internal consensus, shifting hawkish. Masahiko Liu, senior fixed income strategist at State Street Investment Management, said, "The BOJ's hawkish hold today should be seen as much about currency defense as inflation control, signaling growing intolerance for further yen weakness." Federal Reserve. Currency defense, not just inflation control. 2 separate justifications for hiking now. Liu added the yen weakness may stay elevated but will be capped near the 162 mark, the line in the sand, with the JGB curve likely to remain steep in the first half of 2026. Federal Reserve, that is the line. The yen sits dangerously close to it constantly. Rehook, 28-year high yields. Split 6-3 vote, 6.1% producer prices. June 16th looms. Markets assign more than a 70% probability of a BOJ rate hike, with expectations for over 2 additional increases by year-end. The IMF urged the BOJ to continue gradually raising its policy rate toward a neutral level. Bloomberg, the IMF, the International Monetary Fund, publicly urging Japan to keep hiking. That is not a domestic Japanese debate anymore. It is an international consensus. Japanese government bond yields have surged since the start of the Middle East conflict, as higher energy prices intensified inflation concerns and reinforced bets on tighter BOJ policy. Business Standard surged since the Middle East conflict began. The causal chain is documented clearly. Additional pressure stems from the yen's weakness, which drives imported inflation, while oil prices climbed further as President Trump's deadline for Iran to reopen the Strait of Hormuz approached. South China Morning Post. The Strait of Hormuz deadline. Oil prices. Yen weakness. Imported inflation. One chain. Every link in that chain points toward higher Japanese consumer and the producer prices. Last week, the BOJ kept its policy rate unchanged but maintained a tightening bias, with Governor Ueda leaving the door open for a possible April hike. Analysts priced in a potential 25 basis point increase to 1% at the April 28th meeting, the Edge Malaysia. April's hike did not happen, but the door stayed open, deliberately, explicitly. Governor Ueda chose language that kept market expectations alive for the next meeting. Now the ceasefire dimension, because mainstream coverage misread this signal completely. Oil prices fell sharply after the U.S. and Iran agreed to a 2-week ceasefire aimed at enabling negotiations. Attention shifted to diplomatic talks in Islamabad, where Vice President J.D. Vance led a U.S. delegation in meetings with Iranian officials. Business standard, a 2-week ceasefire. Temporary by definition. Negotiated, not permanent, structurally fragile. Markets treated the ceasefire as resolution. Japan's inflation data says otherwise entirely. Japan remains highly exposed to oil supply disruptions due to its dependence on Middle East imports, prompting releases from emergency reserves and efforts to secure alternative energy sources. Bloomberg Emergency Reserve releases. That is not a country experiencing temporary resolved pressure. That is a country managing an ongoing structural energy vulnerability in real time. Now the May producer price data, the number that changes the entire calculus. Japan's producer prices jumped 6.1% in May, the sharpest increase in months. Producer prices are the leading indicator. They predict consumer prices weeks ahead. A 6.1% jump in producer prices means consumer inflation is coming next. The BOJ cannot ignore a leading indicator confirming exactly what 3 members predicted. Rehook, 3 dissenting votes in April. 6.1% producer prices in May, June 16th next. The math the BOJ faces on June 16th is fundamentally different than April 28th. In April, 3 of 9 wanted to hike. The vote was 6-3. In June, the producer price data gives those 3 members new ammunition. It only takes 1 additional vote to flip a 6-3 hold into a hike. The yen has weakened over 1.5% so far this year and is currently trading at 159.12 against the US dollar, approaching the 162 intervention threshold that State Street's Lou identified as the line in the sand. Federal Reserve 159.12, 3 yen from the 162 line. The currency defense argument strengthens daily. Every day the yen sits near that line adds weight to the hawkish camp. Now connect this directly to American financial markets, because this is the point. When the BOJ raised rates to 0.75% in December 2025, the impact was immediate. The U.S. 10-year Treasury yield surged in direct response within the same session. Japanese life insurers and pension funds are the largest foreign holders of treasuries. When Japan's domestic yields rise, those institutions have less reason to hold American debt. Every basis point Japan's bonds yield above the hedged U.S. Treasury return matters. The benchmark 10-year Japanese government bond yield hit 2.496% on April 13th, the highest since 1997, and yields on the 10-year JGBs were flat at 2.468% after the April 28th decision. Federal Reserve, 2.468% to 2.496%, hovering near 3-decade highs even without a June hike yet. A June hike pushes that yield higher still, widening the domestic advantage further. Wider domestic advantage means more Japanese capital repatriation pressure on U.S. treasuries. More repatriation pressure means fewer buyers at America's weekly treasury auctions ahead. Fewer buyers means higher yields, demanded by remaining buyers to absorb the supply. Higher yields on treasuries translate directly into higher mortgage rates for Americans. This chain, Tokyo to Washington to your mortgage statement, is fully documented now. It is not theoretical. It happened in December 2025. It can happen again June 16th. And part 2 is where Capital Word breaks down exactly what June 16th means for the carry trade, what the IMF's neutral rate target actually implies for Japan's terminal rate, why the 162 yen line matters more than most investors realize, and 3 specific actions every American must take before this critical decision lands in 6 days. Part 1 established the full picture, confirmed and documented thoroughly. 28-year high yields, split 6-3 vote, 6.1% producer prices in May. Now the official confirmation, straight from the BOJ's own summary of opinions. Governor Kazuo Ueda's board at the Bank of Japan voted 6-3 on April 28th to hold policy settings unchanged, an unusually divided outcome that pointed to momentum building for a rate increase when authorities next set policy on June 16th. WKZO. Unusually divided. Those are Bloomberg's own words about the BOJ's internal vote. It is quite possible that the bank will raise the policy interest rate from the next monetary policy meeting onward, even if the future course of the situation in the Middle East remains unclear, one board member said, according to a summary of opinions from the April meeting. WKZO, quite possible. From the next meeting onward, regardless of Middle East clarity. That board member was speaking in April, about June 16th specifically by name. Now the carry trade reality check, because Capital Word presents full balanced analysis. Japanese rates, even after the expected hike, would sit at just 0.75% versus 3.75% in the U.S. The yield differential would still remain wide enough to favor U.S. assets and discourage mass unwinding of carry trades. Techie R, a single hike to 1% does not collapse the carry trade immediately or completely. The gap narrows from 300 basis points to 275, still historically very wide, but narrowing is directional. Every hike moves the needle the same way. This move, following a previous hike to 0.75% in January 2026, signals a definitive end to decades of ultra-loose monetary policy and threatens to unwind the massive yen carry trade that has historically supported risk assets. Investing.com, definitive end. Decades of policy. The structural framing matters more than magnitude. Analysts from Bank of America Global Research warn that if the hike proceeds, Bitcoin could face an immediate 4% to 5% decline. Investing.com, 4% to 5% on Bitcoin alone from one rate decision, documented bank research. Now the December 2025 precedent, the live preview of what June 16th looks like. The Bank of Japan delivered a landmark interest rate hike on December 19th, 2025, raising its benchmark rate by 25 basis points to 0.75%, marking the highest borrowing costs since 1995. Science Direct, December 19th, 2025. The exact template for what June 16th could replicate now. The 10-year U.S. Treasury yield climbed toward 4.15% as Japanese capital began the long-anticipated process of repatriation. The immediate implications were felt most acutely in fixed income markets. Science Direct. 4.15% on the U.S. 10-year. From one BOJ hike. Same session market reaction. The BOJ's policy board reached a unanimous decision to lift the uncollateralized overnight call rate from 0.50% to 0.75%, the second hike of 2025, underscoring growing confidence in Japan's virtuous cycle of rising wages and sustainable inflation. Science Direct virtuous cycle. Rising wages. Sustainable inflation. The BOJ's own confident framing language. Confidence in December. A split vote in April. Producer prices spiking in May. Each data point builds toward June 16th with increasing institutional momentum behind it. Now the IMF dimension, because this elevates the story beyond domestic Japanese politics. Nada Chueri, Deputy Director of the IMF's Asia-Pacific Department and Mission Chief for Japan, said the Bank of Japan is likely to raise interest rates again this year, seeing rates reaching levels deemed neutral to the economy by end 2027. Zaya, the IMF Mission Chief for Japan, publicly forecasting continued hikes through 2027. The IMF sees Japan's neutral interest rate in the band of 1% to 2%, with further BOJ rate hikes expected to be gradual and flexible to ensure a pickup in domestic demand. Zaya, 1% to 2%. That is the IMF's neutral rate target, not the BOJ's ceiling. June 16th would put Japan at the very bottom of that neutral range only. That means even after June 16th, more hikes remain consistent with IMF guidance. Japan's economy was projected to expand 1.1% as continued recovery and wage growth underpins domestic demand, though risks to growth remain skewed to the downside as heightened geopolitical fragmentation weighs on global growth. Zaya wage growth underpinning demand. That is the domestic inflation engine running independently of oil. Even if Iran war pressures fully resolved, Japan's wage price cycle continues separately. Now the 162 yen line, and why it matters more than most investors realize. Masahiko Liu at State Street identified 162 as the line in the sand for yen intervention, with the JGB curve likely to remain steep in the first half of 2026. Federal Reserve. The yen sat at 159.12, just under 3 yen from that intervention line. Every approach toward 162 strengthens the currency defense argument for a June hike. A June hike that strengthens the yen reduces the chance of crossing 162. That makes the hike partially self-fulfilling, defending against its own trigger condition. Markets have been wrong-footed by the BOJ's determined stance to normalize interest rates. This resulted in a sharp unwind of yen carry trades, bringing USD JPY down to as low as 142 in a previous episode. The Canadian Vanguard wrong-footed. Markets have repeatedly underestimated the BOJ's resolve throughout this entire cycle. DBS noted that Japanese politicians have become more averse to a weak JPY, and Japan had intervened to support the JPY multiple times this year, with intervention risk heightened whenever USD JPY trades above key levels. The Canadian Vanguard. Politicians averse to weak yen. Multiple interventions already this year. Pattern established firmly. Now 3 specific things every American watching Capital Word must do before June 16th. First, watch the U.S. 10-year Treasury yield in the 48 hours after June 16th. When the BOJ hiked in December 2025, the 10-year U.S. Treasury yield climbed toward 4.15% in immediate same-session reaction. That is, your direct documented transmission indicator to monitor. Science at Direct. If June 16th delivers a hike, expect a similar same-day yield reaction pattern. Second, if you hold leveraged tech positions or crypto, reduce exposure before June 16th. Bank of America. Global research warned Bitcoin could face an immediate 4% to 5% decline if the hike proceeds. And Charles Schwab noted, going long tech and short the yen was one of the most popular carry trades for years. Investing.com. That popular trade unwinds incrementally with every BOJ hike. Tech stocks feel it too. Third, watch the yen against 162 daily as your real-time intervention indicator. If the yen approaches 162 before June 16th, hike probability increases further still. If June 16th delivers a hike and the yen strengthens, 162 risk recedes temporarily. Either outcome confirms the structural direction, narrowing gap, repatriation pressure, higher U.S. yields. Now the complete honest picture, because Capital Word never oversimplifies for clicks. A single hike to 1% does not collapse 20 years of carry trade overnight. The yield differential would still remain wide enough to favor U.S. assets and discourage mass unwinding of carry trades all at once. In other words, the BOJ remains the most dovish major central bank even after hiking. Techier, most dovish major central bank even after June 16th's hike, if it happens. But most dovish is a comparison, not a guarantee of stability indefinitely. The IMF sees the neutral rate at 1% to 2% by end 2027, further hikes coming. Each hike between now and 2027 narrows the gap by another 25 basis points. Each narrowing repeats the December 2025 pattern. Treasury yields rising in response. The producer price spike of 6.1% in May is the leading indicator confirming direction. The split, 6-3 vote in April, is the institutional confirmation of building momentum. The 162 yen line is the trigger condition that accelerates the timeline further. June 16th is not the end of this story. It is the next data point. And every data point since December 2025 has moved in the same direction. Higher Japanese yields, narrower carry gap, more capital repatriation pressure on America, higher U.S. Treasury yields, higher mortgage rates, higher cost of America's national debt. The chain from Tokyo's producer price index to your mortgage statement is real. It is documented. It happened in December. It can happen again in June. 6 days from today, the Bank of Japan makes the next decision in this chain. And every American with a mortgage, a bond fund, or a retirement account is exposed. That is the complete breakdown. Share this with every investor who needs to understand why June 16th matters more than headlines suggest. Subscribe to Capital Word for the financial intelligence that connects Tokyo's central bank decisions to your mortgage, your portfolio, and your retirement in real time. Drop a comment. Do you think the BOJ hikes on June 16th, and are you positioning for it? We read every single one. See you in the next one.